Hi, my name is Michael Berry. I am the managing member for Flagpole Capital and Michael Scott Financial. Thanks very much for joining us. Today we're going to talk a little bit about the 3 ways to address investment risk. We get asked all the time, how do you construct a portfolio? How do you construct a financial plan that allows us to get return but yet protects our downside? So we're going to talk about risk. There are many types of risk. So we have some good news and bad news here. So the bad news is we're always at risk. The good news is that we get to choose which risks we want to address and in which order. Risks like political risk, economic risk, industry risk, inflation risk, market risk. So let's stop on market risk. Market risk happens to be the number one that our clients want to address first because that is actually where we can lose the most wealth. Sometimes it's called investment risk. So let's talk about the 3 ways that we can address that. Number 1, you can avoid it. So the product that we use to avoid is cash. There are other risks that I already mentioned, but the main one when addressing investment risk is cash for avoidance. So avoidance. The second way we address investment risk is we manage our way through it. What are the products? There's stocks, there's bonds, there's mutual funds, there's REITs, derivatives, commodities, ETFs. We can mathematically combine all those using some historical data. And we're going to talk a little bit about robo-advising and technology and algorithms and some future segments. But for right now, we're talking about addressing investment risk. And this is how we manage through that risk. So avoidance, managed. The third way we address investment risk is we transfer it. There are only 2 products in the world that were created, and they were created by insurance companies so that you and I and hospitals, and corporations, we can send dollars to these companies, but what do we get for that? We get guarantees. So the first step in putting together a financial plan or an investment portfolio is to address your investment risk, your market risk, and how much of avoidance, how much of transfer, and how much of managed buckets or accounts do you want? What happens next in the stages or steps that we go through with putting together a financial plan is we'll look at the avoidance bucket, we'll look at the managed bucket, we'll look at the transfer bucket, and we'll have conversations about how to actually purchase those products or how to construct those products to get you the best outcome that's available to you. So if you would send us your statements, there's no obligation, there's no requirement that you do business with us, but we'll take a look. We'll run it through the analysis, and we'll tell you how much transfer you may want to own, how much managed accounts you may want to own, or how much avoidance. In future segments, what we'll be doing is going deeper into managed accounts. We'll be talking about things like robo-advising, things like algorithms that we use to mathematically construct a portfolio. We'll be talking about ETFs, products that you can purchase. We'll be talking about sector rotation and momentum strategies that are very popular that help us contain or manage your way through that investment risk. Future segments will also include that transfer bucket. We'll be talking about those insurance products that I mentioned. There's only 2 that were created that specifically allow us the opportunity to transfer investment risk, and that's cash value insurance and annuities. So because it's a complex subject, we'll be having separate segments specifically on those products, how they work, where the guarantees are, why they're appropriate for portfolios and financial planning. So thanks again for watching. See you soon.